IPO pricing refers to the process of determining the initial price at which a company's shares will be offered to the public during its initial public offering, IPO. The goal is to set a price that balances the company's need to raise capital with investor demand, ensuring the IPO is successful and the shares perform well in the market. The process begins with the company working with investment banks, known as underwriters, to assess its financials, growth potential, and market conditions. These underwriters conduct a valuation of the company, considering factors such as revenue, profits, industry trends, and comparable companies. For example, if a tech company generates $100 million in annual revenue and similar publicly traded companies are valued at 10 times their revenue, the company might be valued at $1 billion. Next, the company decides how many shares it will issue and divides the total valuation by the number of shares to arrive at a preliminary price range. For example, if the company is valued at $1 billion and plans to issue 10 million shares, the price range might be set between $90 and $110 per share. Before the IPO, the company and underwriters conduct a roadshow where they pitch the IPO to institutional investors, such as mutual funds and hedge funds. These investors provide feedback on the price range and indicate how many shares they're willing to buy. This demand helps fine-tune the final IPO price. For example, if demand is high, the price might be set at the top of the range or even raised. If demand is low, the price might be lowered to attract buyers. The final IPO price aims to strike a balance. It should allow the company to raise enough funds while leaving some room for the stock price to rise after it starts trading. A successful IPO often sees the stock's price increase slightly on the first day, signaling strong investor interest. For example, if a stock is priced at $100 per share and closes its first day of trading at $120, it reflects healthy demand. However, pricing an IPO is challenging. If the price is set too high, demand may be weak, leading to a disappointing launch. For example, if shares are priced at $100 but open at $90, it signals that the market doesn't agree with the valuation. Conversely, if the price is set too low, the company might leave money on the table, as the stock could surge dramatically on the first day, benefiting early investors more than the company. In summary, IPO pricing is a careful process of valuing a company, gauging investor demand, and setting a price that ensures a successful public debut. It involves balancing the company's goals with market dynamics to create a strong foundation for the company's journey as a publicly traded entity.